I would point out to everybody right here, big news of the week, subprime lender Primalend Capital Partners files for bankruptcy protection. This was huge. This was coming right on the heels. We had Tricolor Holdings fail a couple of weeks ago. That was followed by First Brands, which failed. And now we have subprime lender Primalend Capital Partners basically throw it in the towel, third big bankruptcies. Now, there have been others, and I'm going to share those with you in a minute as we go through a few of these articles here. But let's just look at this first. So subprime lender Primalend Capital Partners filed for bankruptcy protection on Wednesday in another sign that low-income consumers in the United States are under strain. The company's filing in a Texas court showed that it listed both assets and liabilities of less than $500 million. Primalend provides financing to consumer and specialty lenders through asset-based credit facilities. It also serves the buy here, pay here auto financing market where dealers sell and directly finance vehicles for customers with poor or limited credit. We want to be clear, there is no impact to our dealer borrowers, loans, or terms. No debt is being called due or accelerated as a result of this process, Primalend CEO Mark Jensen said. We are pursuing a sale process to maximize value of the business and strengthen our balance sheet. The company is operating as usual with no disruptions. It said this statement, reiterating that it is not going out of business, even though it filed for bankruptcy. Bloomberg News first reported on the bankruptcy earlier in the day. Subprime lenders provide loans to borrowers with weaker credit histories or lower credit scores. Last month, Bloomberg News reported that Primalend's creditors were weighing pushing the firm into bankruptcy after going unpaid for months. Yeah, that sounds like a problem, right? Many lower-income consumers, according to analysts, are finding it harder to keep up with payments, prompting an uptick in delinquencies across auto, personal loan, and credit card portfolios. The strain reflects the cumulative impact of high borrowing costs, rising living expenses, and depleted savings, which have left subprime borrowers particularly vulnerable to financial shocks. I would also point out that there's this little thing called the border being closed, and that there's this little thing called illegal, undocumented people getting sent back whence they came. That I think is having a crimp on business as well. I think they of course Reuters would leave that out, naturally. But let's take a look at some of these other things here, because I think you guys are going to find this interesting as we roll through this. So auto parts companies' bankruptcies rattle credit markets. What to know? Failures among auto parts firms and subprime lenders may signal broader risks, but a strong economy and falling rates limit spillover, analysts say. Yeah, I don't know about that. So let's see here. So as I said, we had Tricolor Holdings, we had First Brands, and now we've had this Primalend. Now, those are the three big ones. Let's take a look at some of these smaller ones that have also happened that have flown under the radar. So the U.S. economy has remained resilient in recent months, but auto parts companies have not. The increasing number of bankruptcies in the auto parts industry is unsettling the high-yield credit markets, i.e. the private credit market. This upheaval is making it increasingly difficult for low-income consumers to purchase cars and is also compelling banks and financial institutions to write off loans to these failed companies. On June 11th, auto parts supplier Tricolor Holdings filed for Chapter 11 cases in the United States Bankruptcy Court for the District of Delaware to restructure its long-term debt obligations. On August 18th, Car Toys, which describes itself as the largest independent multi-channel specialty car audio and mobile electronics retailer in America with multiple locations across the western U.S., filed for bankruptcy. On September 10th, Tricolor and nearly a dozen of its affiliates each filed a petition in the United States Bankruptcy Court on the Northern District of Texas to transition from Chapter 11 of the United States Code to Chapter 7. This transition allows Tricolor to move from reorganization to liquidation, which involves the ending of the business and the selling of the assets, of which there are not many. And then it goes into, explains there, and then it goes into on September 28th, First Brands Group, LLC, and 98 affiliates. So we had how many affiliates with So Tricolor had a dozen affiliates, and First Brands had 98 affiliates filed for Chapter 11 bankruptcy. The failure of these auto parts companies has sent shockwaves through the higher yield or junk credit markets, with the ICE B of A high yield index rising by nearly 50 basis points since mid-September. Yes, this is causing a problem. And then it gets into, Jefferies Financial, which we'll talk about in a second. JP Morgan disclosed $170 million charge off. Jefferies Financial expects to incur a $43 million loss resulting from First Brands. The situation worsened toward the end of the week as a couple more regional banks, Western Alliance Bancorp and Zions Bancorp, announced write-offs, prompting a sell-off on Wall Street. Auto-related bankruptcies of companies like First Brands and Tricolor signal stress in pockets of corporate lending to consumer-facing companies, but they also reflect consumer demand headwinds likely to impact other industries. And again, I wanted to read this to give everybody a flavor for there are a number of companies that have failed here in the last, just in the last, 2 months. This has not been a one, we're going to see some other articles here in a little bit as we go through the night here. We're going to see some articles here that are basically going to try to describe this as a one-off, this is a bad debt, but it's just a one-off. It's a one, no, this is not a one-off. This is not a one-off. I'm presenting you the evidence here that this is not a one-off, that there are multiple. We're now up to 5-6 different companies that have now gone under. Let's see here. Now let's get into Jefferies here. Now Jefferies, very interesting company that was tied in with certainly with First Brands. And how did they get into the middle of this? And now they're crying foul, basically saying that they were defrauded. So Jefferies shares pair losses after CEO says First Brands defrauded the bank. Rich Handler doesn't see the collapse of the auto parts supplier as a sign of broader credit issues. They never do. It's funny, if you study markets and financial crises long enough, you see there's a pattern. The first thing is when a big company goes down, the first thing they say is like, oh no, there's not a bigger problem, nothing to see here, everything's good. It's always the first thing. So Jefferies Financial Group appears to have calmed investors' worst fears about the bank's involvement in the collapse of auto parts maker First Brands Group. We believe we were defrauded. Jefferies' chief executive officer, Rich Handler, said at the bank's previously scheduled investor day on Thursday. Jefferies shares rose nearly 3% Friday after having tumbled 11% Thursday, following a report in the Wall Street Journal that detailed the firm's ties to First Brands. We're going to get to that in just a second. Concerns about wider credit issues also had sent the banking sector tumbling Thursday. Jefferies shares are still down around 20% over the past month. Jefferies had been hired over the summer to help First Brands refinance corporate loans, while its asset management division had extended $715 million of financing ties to the company's accounts receivable. The financing never happened, and the asset management division stopped receiving payments from First Brands in mid-September. Roughly $45 million of the financing was held by a Jefferies fund, while its investors held the rest. So First Brands filed for bankruptcy. It's very clear, and we're as frustrated as anybody else. We don't know exactly what happened with First Brands, and the details will come out as the bankruptcy process unfolds. First Brands declined to comment. Fears about systemic credit problems Thursday were primed when a fresh instance of alleged credit fraud was disclosed at 2 smaller banks, but banking stocks edged up Friday. Fifth Third Bancorp, which initially raised concerns about fraud at subprime auto lender Tricolor, sparked those broader issues. Said Friday it had given its portfolio a comprehensive review and wasn't concerned about a broader credit collapse. Now, if everybody remembers, with Fifth Third Bancorp, I just did an episode a week ago. They just did one of the biggest M&A transactions in years by agreeing to purchase Co-America for $10.9 billion. So, and then of course, right after that merger, they were forced to release information here on Tricolor Holdings and basically say that, like, yeah, we're going to take a hit from Tricolor. And on we go here. So, but let's look at, so how did Jefferies end up at the center of this? This is the big question. So the investment bank's deep ties to the auto parts maker draws questions. So the sudden collapse of auto parts giant First Brands Group has left Wall Street firms sorting through the wreckage. Few are facing more questions than Jefferies Financial Group, a supporting player in the finance world that now finds itself in the harsh spotlight of an accounting scandal. The firm played important roles with First Brands through both its investment banking and asset management division. First Brands sells billions of dollars worth of parts, including oil filters and windshield wipers, annually to customers such as Walmart. The Cleveland-based company filed for bankruptcy. First Brands unraveling has raised questions about who could have seen it coming. Jefferies had worked with First Brands for several years without issues when its bankers set out to help the company refinance corporate loans over the summer. Jefferies initially told prospective lenders that First Brands had roughly $5.9 billion of debt, according to materials viewed by the Wall Street Journal. First Brands bankruptcy advisors have since said its debt actually exceeds $11.6 billion. In the marketing materials, Jefferies highlighted a financing arrangement for First Brands in which the company sold accounts receivable to financial institutions, but it didn't spell out that in some of these deals. Money flowed through First Brands before it was repaid to the institutions. Jefferies told lenders that these financing arrangements weren't debt-like. Jefferies shares, which hit a record high late last year as the bank executed an aggressive plan to lure top bankers and work on bigger deals, are now down nearly 30% since last month. Although they did, you can see in the chart here, their shares did rebound a little bit here. So Jefferies had worked for First Brands and a predecessor since 2014. Its investment banking and capital markets divisions, which accounts for the bulk of the firm's revenue, have advised the auto parts supplier on one acquisition and various financing efforts. So in other words, Jefferies had been tied to First Brands for quite a while. This wasn't a new relationship. This was a relationship that had gone back at least 10 years and had multiple facets to it. There was kind of like the financing arm and the hedge fund arm, or investment banking arm, if you will. And basically what Jefferies was doing, at least on the finance side, was basically providing what's called factoring financing. Basically, you're basically lending against accounts receivable. The problem is that First Brands, at least apparently, looks like they pledged the same collateral to get multiple loans with multiple different organizations. That's why the people at Jefferies are saying, oh, we got defrauded, because we didn't know that they were out there, pledging the same collateral for a number of loans through a bunch of different. Remember, we said a few minutes ago they had 98 affiliates. It was through, they acquired financing through all these other affiliates using the same collateral from the main First Brands entity to support all this. And that's why it's a big fraud. It's a giant mess. But it also just goes to show you that, what is out there. Like, in other words, Jamie Dimon described this week as cockroaches. He basically said, where you see one cockroach, there's usually more. And I agree with that sentiment completely, because that's basically exactly what we're seeing right now. We're seeing an unfolding of more of this. Now, let's take a look at a couple other things here real quick. So the alleged sweeping betrayal of trust that rocked Zions Bank and spooked Wall Street. So Zions Bank Corporation lost $1 billion of its valuation in a single day on Thursday after disclosing $60 million worth of loans it had made that were unlikely to be repaid. What led to that point was a messy, tangled web of loans that Zions said were surreptitiously subordinated by the borrowers, all while the collateral was effectively eliminated. Shares of regional banks tumbled on Thursday as fears mounted around the health of their lending businesses. Zion's 13% share plunge ended up sparking worries about possible broader issues with lending for the regional bank sector, knocking the whole U.S. stock market on Thursday, with the Dow Jones Industrial Average finishing lower by 300 points. Zion's subsidiary, California Bank and Trust, is suing Andrew Stupin and General Marcel, the until now relatively unknown managers of several funds utilizing the name Cantor Group, along with their associate Deba Sham. The lawsuit filed in Los Angeles County on Wednesday alleges a sweeping betrayal of trust by sophisticated financial borrowers who abused CB&T's confidence, manipulated loan structures for their own enrichment, and systematically eliminated the collateral protections that were supposed to secure the bank's loans. Zions and a lawyer representing the defendants didn't respond to CNBC's multiple requests seeking comment. The relationship in question stemmed from about $60 million in financing that Zion CB&T made in 2016 and 2017 to two related investment vehicles, Cantor Group 2 and Cantor Group 4, which tied back to Jefferies. The credit facilities were to be used to fund the purchase of distressed residential and commercial mortgage loans. Zion said they had an underwritten agreement guaranteeing them first priority interest, meaning the bank's claim on collateral was superior to other credits claims in the event of default. However, the deeds that were supposed to secure the loans were ultimately subordinated without CB&T's knowledge. Zion says in the lawsuit, those underlying properties were transferred to other entities or were in foreclosure, meaning the collateral was irretrievably lost. Yeah, so so this is again, so what you're seeing here is a ballooning issue with multiple issues running through, kind of exactly what they said, a web of loans, web of collateral, tying in a whole bunch of different lenders, pulling a lot of people into this. This is what you call contagion. All right, now let's examine these related things for a second. So Americans are falling behind on their car payments. So delinquency rates on subprime auto loans are at records. And wait till you see this chart. One of the cylinders in the U.S. economic engine is causing some sputtering. Since the pandemic, buyers on auto dealer lots have encountered surging sticker prices and smaller incentives from automakers to lessen the blow. To afford an automobile, more consumers, especially lower-income families, have resorted to buying used cars and taking out longer loans. Now, more are falling behind on their loans, signaling that lower-income consumers are struggling to afford payments as wages stagnate and unemployment ticks higher. While the economy has remained strong, the Wall Street Journal has kept buying subprime auto. The Wall Street has kept, but not the Journal, has kept buying subprime auto loans. The auto market is evidence that not all is well under the hood. The percentage of new car buyers with credit scores below 650 was nearly 14% in September, roughly 1 in 7 people, J.D. Power said last month. That is the highest for the comparable period since 2016. And the portion of subprime auto loans that are 60 days or more overdue on their payments hit a record of more than 6% this year, according to Fitch Ratings, while delinquency rates for other borrowers have remained relatively steady. And I mean, just look at this. I mean, look, the prime borrowers have remained pretty steady here at the bottom. Subprime, I mean, you could just see, this is spiked up. When was this? So since May of 2021, over basically the last 4 years, for basically about 4.5 years. I mean, this is what you call skyrocketing delinquency here, which is pretty crazy. And you could begin to see here how this is tied. This is what I'm trying to do here. I'm trying to show everybody a flow of articles that is going to begin to paint a picture here as to what is going on here. So it's not just, so these companies are failing, but it's a lot of these companies that are tied into the subprime auto market. And now you could begin to see from this chart here that the subprime auto delinquency is beginning to skyrocket. Now, 6% in the grand scheme of things, that may not sound like a lot, but it's a lot. It is a lot, but I'm telling you. So if I could put this in like a banking terminology for everybody for a second. So if you look at a bank, when you're looking at a bank's delinquency and you're trying to gauge, like, okay, is their delinquency good or bad? So think about it like this: if a bank has 1% delinquency, that's kind of average. It's about, so basically 0.5% to 1% is kind of average for just about every bank out there. It basically signals that they have very, if a bank's got, like 0.75% delinquency, they got pretty strong credit quality. Credit quality is usually pretty good. Not too much is going on there. They might have one or two bad, maybe they have one large bad loan that maybe caused some problems or something, but nothing to be panicked about. Not the end of the world. Okay. If a bank is below 0.5% in delinquent loans, they're doing really good. That means their portfolio is really pristine. If a bank is over 1% in delinquency, that's when you should start asking questions. If a bank is like 1% to 1.5% delinquency, you should be going, okay, that should be setting off some red flags, and you should be going, okay, what's going on there? Why is that bank's delinquency elevated? You would consider that a 1 to 1.5%. You would consider that elevated delinquency. If you see a bank that's got just 2% if they have just 2% delinquency, there is a big problem going on there at that bank. And you need to start looking in there and going, okay, what you need to start looking under the hood and going, okay, what is going on here? Because something big is going on here. And I want people to realize that it does not take a huge amount of delinquency to sink a bank. Like, in other words, like if I asked people on the street and I said, if I just went up to somebody and said, listen, how much delinquency do you think it takes to sink a bank? You know, like how much of their loan portfolio needs to go bad? Is it 5%, 10%, 20%, 30%? I think a lot of people would probably go, oh yeah, like, probably, 20, 30% of their portfolio probably has to go bad before they go under. No, 5%. Yes, 5%. If 5% of a bank's loans go bad, they could probably go under. Now, the one thing that's in banks' favor right now is that capital ratios are much higher than they were. If you go back to the 05, 06, 07 time period leading up to the Great Recession, and the big financial market collapse and everything in 07 and 08. If you go back, a lot of the bank capital ratios back then were only 4, 5, 6%. And so if a bank had 5% delinquency and you only had 5% capital, guess what? Game over. Game over. Now, a lot of banks out there have, 9, 10% plus, capital ratios. So they certainly have a lot more capital with which to combat, delinquent loan issues. That being said, you start getting 4, 5, 6% delinquency. That's a major problem. And that is still a problem that could potentially sink a bank. So again, it does not, the reason why I point that out is like, it does not take that much to sink a bank. And that's why, when you see subprime debt at 6.43%, that is huge. That is a huge number. And that's why, to me, this is a big deal. This is a big deal to look at this. So, all right, let's go on here. Demand surges for private credit secondaries amid market volatility. Now, this article was from October 8th. This is going back about 17 days now. But I just want to show this to you. This came out just before a lot of these stories started to pop. So general partner-led deals are helping to boost credit secondary growth as the private credit market continues to mature. So the secondary market for private credit assets may be much smaller and younger than its private equity counterpart. Not much, but it is rapidly gaining ground. We're seeing a substantial increase, said Jeffrey Griffins, the global head of private credit at private capital advisory firm Campbell Lyons. These transactions have picked up the pace this year. Secondary deals for private credit assets exceeded $12 billion in 2024, up from around $9.8 billion in 23 and just $7 billion in 2022, according to a recent Campbell Lyons report. Each projects deal volume will top $14 billion this year. Secondary investors and intermediaries expect the uptick in private credit secondary deal making to continue into at least the first quarter of 2026, with some managers even expecting the spike to become a permanent feature of the private credit landscape. Yeah, we shall see as all these deals continue to go bad. We'll see here. Now, and again, this is only talking about a specific feature of the private credit market, not the entire private credit market itself. The entire private credit market is now up to about $1.7 trillion. $1.7 trillion. This is just the private credit secondary deal volume surges. So this is just in one aspect of the private credit market. But I wanted to, just show this to people, just to give everybody an idea, that this, the private credit market continues to churn. It continues to churn, continues to grow every day, without a lot of, nobody's hitting the brakes right now is basically what I'm saying. You're still seeing, you're seeing deals, you're seeing deals go, but again, nobody's hitting the brakes. These things are still flowing. They're flowing right along. To wrap up here for tonight, I'm going to go rapid fire through a bunch of articles here. We're going to get back to what we started with at the beginning of the night. I want to show you guys now some things that came up with a lot of these other banks as it related to this whole kind of credit quality issue, as it relates then ties back to, again, the private credit market, the subprime auto lending issues. So Fifth Third, Truist flag non-bank lending. In other words, the lending they did in the private credit market. So as Zion's, Western Alliance, and other banks revealed exposures to non-bank lenders, one analyst noted that concern around the sector is the topic du jour. Oh, you bet it. Better believe it. So Fifth Third logged 778 million net charge-off in the third quarter, tied to a bankrupt subprime auto lender Tricolor, as concerns around banks lending to non-depository financial institutions, NDFIs, I talked about that last week, proliferated during this week's earnings calls. So additionally, and then let's see here. Additionally, Regions lenders Zions and Western Alliance this week disclosed bad loans linked to allegations of fraud. JP Morgan said they were writing off 170 million. So again, there's some growing fears of more cockroaches, has heightened concerns related to regional banks in particular, where losses may be more consequential than for mega banks. Investors are now squarely focused on NDFI risks, and little else even matters for banks when credit questions emerge. Yes, I would agree. And then we're going to go in here. So credit quality shadow hangs over U.S. banking industry third quarter earnings calls. So credit quality was top of mind during U.S. bank earnings calls as the industry reeled from a spike in one-off credit events. Remember what I said earlier? Everyone's going to describe these as one-off credit events. Oh, this can't happen. Oh, don't worry about it. No big deal. And again, we talked about this, but Zion's related credit issues during the quarter, 50 million in charge-offs. There's Huntington Bank shares. There's a number of banks here have said basically, hey, they got some stuff. Similarly, United Bank executive said his credit metrics were roughly flat even after the company disclosed a 26 million non-accruing NDFI loan and reserved 19 million for two other loans that generated 14.7 million in charge-offs. And despite reporting a 30% sequential increase in non-performing commercial and industrial loans, resulting in part from exposure to the First Brand's bankruptcy. So, so U.S. Bancorp President and CEO Gunjan Keita said the company remains confident in its underwriting. So, and then you had other credit events, other credit events during the third quarter, not limited to NDFI lending. So Washington Trust Bancorp faced tough questions around its credit quality during an October 21st earnings call. In two other examples, Bank of the OZK had 3 negative credit migrations. Service First bank shares reported an increase in non-performing assets. M&T Bank's net charge-off rate increased 10 basis points during the quarter. So again, this is not a one-off. You are seeing this now a bunch of regional banks. What B of A CEO calls for more regulatory oversight of non-banks. Bank of America Chair and CEO Brian Moynihan called for more oversight of the stablecoin and private credit industries as they encroach on banks' territory. As stablecoin gains traction as a payment option, banks need to innovate in order to not lose deposits, Moynihan said. And let's see here, recur companies. Moynihan also touched on the rise of private credit, calling the playing field unlevel, since those companies make loans like banks do without the oversight banks receive. Oversight cannot be compromised without returning to a system in which all parties are free to do what they want, he said. Moynihan cited the creation of the Consumer Financial Protection Bureau, which was partly intended to bring financial companies outside the existing regulatory regime under more oversight as an example. They were not in the same regime, and so the idea was to close it down and say, if you make a mortgage, you're going to have the same regulation of activity. So again, but he's calling, the CEO of Bank of America, he's calling for this now. Western Alliance CEO says alleged loan fraud is incredibly frustrating, but an isolated issue, the one-off. It's an isolated issue. Western Alliance is one of the regional banks facing concerns over loans made to non-bank financial players. The bank CEO said he believes the alleged loan fraud that sparked a sell-off last week is an isolated case. The Cantor Group episode forced Western Alliance to review other loans in its note finance portfolio. So, yes, and then we continue on here. Service First, underperforming assets jump, share price faces pressure. So an increase in Service First bank shares non-performing assets was driven by the company's relationship with a borrower that rehabilitates multifamily properties. So again, issues there. Zions elaborates on NDFI risks after large charge-offs. So Zions Bank provided some additional color after its lending to non-depository financial institutions and the general risk posed by private credit, while otherwise declining to disclose further details on credit losses related to 2 loans. So yeah, so you can be sure that Zions is going to have some other bad loans cropping up here. Ally shrugs off consumer credit worries as auto loan losses improve. So Ally Financial pushed back against fears of consumer weakening, reporting stronger auto loan quality for the 3rd straight quarter. Okay, maybe. I would go back to this 6.43% subprime. Yeah, I'd go back to that. Barclays is satisfied with their private credit exposure after the Tricolor hit. So Barclays announced that they were taking $60 million hit here for Barclays, something in that range from First Brands. They announced $110 million impairment charge related to exposure to Tricolor in the 3rd quarter. Barclays taking a big hit here on this. Bank United calls problem credits an exception. So Bank United has set aside $19.1 million primarily for a commercial industrial loan and a commercial real estate office loan that generated $14.7 million in net charge-offs, and reported that a $26 million loan to a real estate investment fund is non-accruing. The company has $1.3 billion in exposure to non-depository financial institutions. So yeah, you can bet that more will be cropping up with that. First Citizens quantifies First Brands exposure, expresses confidence in credit. So First Citizens Bank share posted a jump in 3rd quarter charge-offs driven by exposure to First Brands Group, while broadly expressing confidence in its credit book. So again, I'm just showing you guys the pattern here. I'm showing you the pattern of all these banks. Eagle Bank Corp shares dropped by in the 3rd quarter. Loss surpasses estimates amid credit noise. Eagle Bank Corp is facing stock price pressure and reporting a 3rd quarter net loss that was worse than analysts expected.